Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, everyone, which is interestingly the title to this week's Facts versus Feelings podcast. Guess who's back? This is episode 119. Sonu and Ryan here. Sonu, it's freezing all around. It was 6 degrees this morning. Took my dogs to the groomer. My one dog, Mabel, my Great Dane, she doesn't like the cold. My other one, Walter, the Great Pyrenees, loves the cold. Couldn't get her to go to the bathroom before because it's just too darn cold. How's Chicago treating you?
It is -3 degrees.
My
kids are off school. They were supposed to be off school anyway. They were off school yesterday and today, so I have to take them to camp today. It's an indoor thing, obviously, but it's a climbing thing. It's a climb zone. They love it. They're pumped about it. But I can't believe you started the episode without mentioning, can I do the sign? Now, if you're watching on YouTube, like OHIO, my kids are going crazy. Yeah. They were celebrating. We didn't let them watch the whole game. OSU was comfortably in the lead, I think, when they quit the first half and went to bed. But they were thrilled this morning. They're still jumping around, I think.
Yes, as a lifetime Ohio State fan, that was a good run. Ohio State beat the number 1 team, the number 3 team, the number 4 team, and the number 7 team in the 4-team playoff. They beat them by an average of 18 points. Every single team by double digits.
I'm going to ask you one of those trick questions now. Not a trick question.
Let's hear it. Okay.
Would you take a defeat as an OSU fan? Would you take a defeat from who I'm talking about, Michigan, if you could win the national championship?
I guess so, because we just did. So I guess so. We'll see. That's a week we don't. Yeah, Ryan Day for some reason has problems against them. Just throw the ball up in the air and you probably would win. So,
Good day. Congratulations, OSU. Fantastic victory. I'm married into an OSU family, so
there you go. Yeah.
I feel part of that. My sister-in-law was at the stadium yesterday with her son. I was like, just stay safe.
Yes. Yeah. No, it's exciting times and late night, but hey, we made it. So, I don't know. What do you want to do now? What do you want to talk about, Sonu? We said, guess who's back?
You can kind of OSU's back.
Yeah, OSU's back. President Trump is back, and the bull market. We think the bull market. They might have left for a minute or two. Bull market. So we're going to talk about those things. We'll talk about the markets, maybe a little bit about inflation, the labor market, and then President Trump is back. Kind of some of those policies. But let's just start markets. Listen, we had last week one of the best week since the election. Obviously, December was kind of weak. We heard all about this bad breath. And I'll just say this, and then I'll turn it to you, Sonu. I was playing with some numbers before. By the way, I had a forced restart, a forced upgrade. It said I had to do it by a certain time, or in the middle of this, we were going to lose me. So I didn't quite do as much research as I wanted, but I will say this. Using data back to 1920s from our friends over at Ned Davis Research, we now had every day last week, so all 5 days, had more than 55% of all the stocks on the NYSE advancing. So everyone told us how bad market breath was, and how bearish it was going to be. We kind of said, I'm not so sure about that on some previous podcasts.
They've been telling us for 2 years now.
Yeah. And that's one of the longest streaks we've seen. Did have a 6-day streak back in November 24, but that's pretty long. Now, here's the really interesting one. Jason Gephardt does amazing work over at Sentiment Trader, did a tweet. He said 5 days in a row now, 68% of all the S&P 500 stocks have been advancing, right? So higher, 5 days in a row, at least 68%. He said that ties the longest streak since 1928, according to Jason's data. You've got September 2009 in there, pretty good time to be long. July of 21, not a good time at all. But then the other two, January and June of 2019. So again, small sample size, yes. Fairly more recently, as you have more ETFs and more potential. What am I looking for? Pennies, not trading eighths anymore. But it is what it is. Sonu, we've seen a massive change in breadth. Everyone told us how bad it was, and then it wasn't. And you just pointed out to me, and I'll shut up now. Mid caps, and quietly, are leading. It's early, but they're leading this year. So we are seeing some broadening out. What do you want to add to that?
No, exactly. When you talk breadth, everyone usually goes to small caps, right? Or large caps versus small caps. I think mid caps are this forgotten class in between. And even when you talk about like the equal weight S&P 500, I mean, I know I've brought this up before. You look at all the wiggles and squiggles and all of that, it almost perfectly matches what you see with mid caps. It's very correlated. The equal weight S&P 500 and the S&P 400 or Russell, the Russell mid cap index, I should say. But last week, going to your point, the S&P was up 3%, 2.9, something like that. Small caps are up 4%. Fantastic. Mid caps are up 4.5%. Year to date. It's not been, too long, right? 17 days, first 17 days. We're recording this on the 21st of January. I almost said February, but January.
Almost.
The S&P 500 is up 2% year to date. Not bad, I imagine, Ryan, for January. Like that's a good return considering we didn't get the Santa Claus rally and all of that. Small caps also up 2%, but mid caps up 3.5%. How about that? How about them apples? Guess who's back?
There you go. Guess who's back? The bull market. We'll add to some fun here. Some interesting things I've noticed over the past week or so. Sentiment, in a lot of ways, has gotten extremely, extremely dour, extremely skeptical.
Again?
Because, all of a sudden, because we had a bad December and kind of a weak-ish start to the year and, new administration, all the stuff, all the tariffs. We'll talk about some of those things. But Sonu, according to the Investors Intelligence poll, where is it? There it is. Which looks at newsletter writers. Okay, so it is what it is. Okay. They've got currently the highest number of bears since January of 23. Now, remember January 23? Everybody told us how bad everything was. Median. Let's see, the Bloomberg survey, the median strategist was looking for negative returns. As people know, listen to this podcast, we were in the other camp there, thankfully. But that's a lot of skepticism. In 1 week, that was the largest jump in bears in the Investors Intelligence Sentiment poll since March of 2020. I don't quite know why everyone just freaked out, but they did. Now, adding to this a little bit more, money market. So that's a poll called soft data. Look at money markets. We saw the largest surge into money market funds last week, or maybe technically it was 2 weeks ago because data came out last week. Since, are you ready for this? April of 2020. I mean, listen, I don't know why people are panicking in the face of a bull market. We've been saying it's a bull market. Last week, we talked about our outlook, why we didn't see a recession coming, maybe a little more dovish Fed. Yes, we need that dollar to come down, yields to come down. We're starting to see some of those things. We'll probably talk about that more in the policy discussion with President Trump. But the reality is there's a lot of fear out there, fear that has been consistent with major market lows. The S&P is 1.5% from an all-time high the time we're recording this. So this time is a little different. The four most dangerous words this time is different, Sir John Templeton. But the reality is when I see people fearful, when I see credit spread still strong, when I see high yield hanging in there relative to treasuries, we see new all-time lows, new all-time relative lows in staples relative to the S&P 500. You've got consumer discretionary outperforming staples and different things. You've got the right leadership. Everyone told us about this rotation, away. Things are rotating just fine. So I never bought into the weak breath that all these, what do you call them, armchair quarterbacks were telling us about breath being weak. And now here we are with all this negative sentiment, and this unwind is taking place. And it's a good. I like it. I like when you have a choppy market for a while, some frustration. Everybody gets all bared up, and then boom, you blink, and now we're flirting with all-time highs. There's some still reasons to think we are in a bull market still. What do you want to add there?
I was laughing because I suddenly got when he said the rotation is fine. I had a picture of you in one of those car repair shops, looking at your car from the underside, and like, yeah, the rotation's fine.
Hopefully I'm paying for that. I'm not very handy when it comes to fixing anything, but yeah.
Same. But no, look, I think one thing that has happened is we've felt that push and pull between, take rotation on one side, bad breath, right? What drove it? You mentioned the dollar. We'll talk more about the dollar when you talk about policies and stuff like that. But yields went up, right? And that push-pull between, are things too good? We saw a bit of that with the labor market. What does that mean? Why is good news bad news? That's because, the Fed may raise rates, right? Forget raising rates. They may not cut rates. I think there are a few people maybe suggesting rate hikes. I think some bond traders are betting on rate hikes. I mean, at the margin. The base case is still cuts. Right now, I think markets are expecting at least one cut this year and about 65% probability of a second cut, right, in 2025. Last week, it was, a couple of weeks ago after the labor report came out, it came out really strong. 256,000 payrolls rose by in December. That's huge, right? The expectations were for a 165,000 increase. The 3-month average is down to 170,000, which is solid. In 2019, it was 166,000 monthly payroll average. Unemployment rate down to 4.1%. Markets tanked. Tanked. The probability of a rate cut went much lower, right? I think it was one cut and maybe 10%, 20% chance of a second one. And the first cut was not coming through June. And then last week, we got the other side of that. We got positive inflation data. Inflation surprised to the downside. And then markets went the other way. We saw this big rally that you just mentioned. The S&P 500 is up close to 3%, small caps, mid caps even more. And I think, look, markets like that, easy inflation data, maybe the Fed will cut. And right now, I think markets are pricing in the first cut by about May as opposed to June.
Okay. No, and we talked about this last week, right? And we've had a lot of downloads and listens, especially on the YouTube channel, which is great when we did our 2025 outlook. That a year ago, we were being told 6 or 7 cuts. We said, probably more like 3 or 4 because the economy's hanging in there. That played out. And now here we are, probably pulling a 180. We're hearing, only one cut, or some really smart people we respect are saying hikes. We're not so sure. We think the other side of that. I will say, you kind of jumped into the jobs data. I do want to point out one thing you mentioned. Here it is. Workers, how do I want to say this? I can't even read my own writing now. But workers part-time for economic reasons has been down 4 months in a row. If people are taking part-time jobs for economic reasons, that normally means what? Things are kind of bad, right? So they're looking for more work, looking for more reasons to make a little more income. But you pointed out 4 months in a row now. I haven't heard, honest to goodness, anybody talk about this, but you did in your your daily note that you sent out to our almost 500 Carson partners all over the country. Why is that? I mean, why does that matter? And down 4 in a row, what does that mean to you?
No, I think you put it pretty nicely. It's as simple as that. Usually, if jobs are tough to find, you know what? I'll just take the part-time job, right? And that's what they mean by workers working part-time for economic reasons, right? As opposed to like other issues like I don't have childcare or I have to, some sort of illness in the family, something like that, right? But economic reasons is what you actually want to look at because such a labor market stuff. But what we actually see is that the labor market, yes, there was a little bit of a scare. Remember last summer?
Sure.
That's why the Fed went big. I mean, we were talking about it. I thought they should go big. I still think, inflation is, now last year's problem. Last year he's saying it was last year's problem. So that is a problem for 2 years ago. They can still cut. I mean, people are saying, why should the Fed cut now? Well, if you don't have inflation, if inflation's normalized, why should they keep rates where they are? But anyway, going back to workers working part-time, yes, it fell for the 4th straight month. It reversed that increase we saw last summer. The current level of workers working part-time for economic reasons, that's now lower than a year ago in January 2024. And then the other side of it tells you that the labor market is stabilizing, as I mentioned. The number of unemployed people who are permanent job losers. So they've lost their jobs. It's not temporary or anything like that. They actually have to look for a new job. And that pulled back to 1.7 million. Just to give you some context, that is also the lowest since last January. This is positive. It tells you 2 things. Things aren't as great as they were 2 years ago, but the weakness we saw last summer, that's reversed, and we are back to where we were a year ago.
Okay.
If that made all sense. If that made sense.
Yeah, I mean, hey, I think so. I think that did. I know, so again, on the YouTube channel, we're going to be sharing more images and charts, and Sonu, we might
I'll share that chart for the workers working part-time for economic reasons. Yeah,
so we'll have that shared when we talked about it. That's a good one. One other fascinating thing I thought, we keep hearing how weak housing is, and it is. I mean, I'm not minimizing that, but how construction could be in trouble. But you pointed out before, construction actually created 8,000 more jobs last month. And for the year, 148,000, that's up 2.4% year over year. Not saying that's spectacular, but honest to goodness, that surprises I don't know. I guess it surprises me. Should we be that surprised construction jobs have held in? Because we've been told manufacturing and all those parts are slowing down, negative, under 50 forever, how many months, years in a row it's been. But then you look at the actual manufacturing output, and it's like flattish for the year. We're not saying that's great. We're just saying we're seeing one thing, and the people are saying another. What's your take on construction jobs?
It is puzzling from the perspective that mortgage rates are 7% plus. Builder confidence is slightly going up, builder optimism, but it's still well below what we saw in 2021, 2022, let alone even before the pandemic, right? So you think, wait a minute, where's all this construction employment coming from? The thing is, there are so many homes, both on the single family and multifamily side, that's under construction, right? Single family homes, I was just pulling this data up. Right now, units under construction, single family homes, 22%, Ryan, above the 2019 average. 22% above, right?
Okay.
You look at multifamily units under construction. If you just look at the line with no context, no x-axis, whatever, again, I'll put this up online too, at least on the YouTube channel. But straight shot down, that's coming down. Multifamily is struggling, right? But even now, units under construction is about 27% above 2019 levels. There's a lot of construction happening, which is why, as you said, construction payrolls are up 2.4% year over year. A year ago, it was 3%. By the way, 2.4% is still pretty good. Now, we don't want that line to keep going down, hitting zero or becoming negative. Back in 2019, December, it was just under 2%, right? But again, that downward trend is something to keep an eye on. It's not just units under construction. There's a lot of renovation happening. Industrial facilities, you and I have talked about that. Manufacturing facilities, semiconductor chip plants, battery plants, all of that, right? So there is a lot of construction happening. The trend on the residential side is something to keep an eye on. We got some housing data last week. Hopefully things are sort of like bottoming out. I don't want to say it's an uptrend yet. We'll see, right? It's pretty volatile data as well, but at least it's not sinking further.
Okay. No, good stuff. Good stuff there. One other thing I thought was interesting you pointed out was aggregate income. The last 3 months, annualized 5.4%. It was around 4.8% pre-COVID. That's one thing you've talked a lot about. For honestly, it feels like 2 years now. Yes,
I feel
no one
like
likes
it's
inflation.
been in all our outlooks.
Yeah,
since you and I've been here.
Till it stops working, that and profit margins hitting new highs and earnings hitting new highs. Reason to be bullish. But anyway, yes, we're going to talk about inflation. Inflation's, I don't know, round 3, maybe a tad less. We think it's actually lower, but the data we have is the data. But still, we know incomes, aggregate incomes, wages, and those things are still growing comfortably more than inflation. And those are some definite positives. Anything else on the, one final one. Last year, so that's 2024. The United States created, and this can, again, change with revisions, but 2.03 million jobs for the year. There was 2.4 million last year. And I think it was, 4 million 2 years ago, I believe, in 22. So, yes, it's slowing, and it'll probably be less than 2 million this year. I think. That's not, I think we think, and I even say that, I think we think. Anyway, but the reality is, again, this economic cycle is aging. But as we talked about last week in our outlook, just because it's aging doesn't mean it has to end. But 2 years in a row, 2 million jobs, Sonu, that's pretty good, right?
That's very good. And it's the unemployment rate is at 4.1%. And what matters for the economy is, income growth, right? The number you mentioned, aggregate income growth, that is basically a product of what? Employment growth, right? Workers' hours worked, right? And worker wage growth. Now, employment growth has slowed. Last year, this time, 2 years ago, it was running about 250,000 jobs a month, right? That's why it created 3 million, 4 million jobs. That was never going to continue. Now it's slowed down. I think, we wrote in our outlook 150 to 170,000. That's what we expect. So where does, 5% aggregate income growth come from? Wage growth for the most part, right? Wage growth has run at an annualized pace about 4%, something like that. That's still strong. It's not much higher than what we saw before the pandemic. But another important thing here for the Fed, we'll talk about that, right, is that there aren't any demand side pressures in the economy. Powell's admitted that. Powell said, you know what, we don't think the labor market is too hot. We don't think the labor market is contributing to inflation, excess inflation at this point, right? And we'll talk about inflation, how excess inflation, all the lagging stuff. But look, over the last 3 months, aggregate income growth, as you mentioned, 5.4% annualized pace. If you think about it, that's like the speed limit for the economy, right? That for a speed limit for nominal GDP growth, 5%, that's very strong, especially when we think inflation is running closer to 2% as opposed to 3%.
No, all well said. Maybe we can dive into that. So we'll talk about inflation here for a little bit, and we'll also talk about President Trump and potential policies and things. But I do want to point out, if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback, so thank you for that. And then I do want to say, I didn't really ever mention on this podcast, my brother was diagnosed with stage 4 cancer back in Memorial Day, Friday, Memorial Day. We knew it was bad. He had a rough go of things. He passed away 2 weeks ago, I guess. So we had his funeral really a memorial, really just a big pizza party is what we called it on Sunday. I've had a lot of people reach out and say condolences and just neat things. It was fun on Sunday because we had a house full of people. And my brother did not rare, wrong word, but he did toys. My dad did rare coins. My brother did like G.I. Joe. So he had all these G.I. Joe friends that flew in from all over the place. That's what he did for his job, and flew around and sold toys and had a brick and mortar store. And it was really fun to honor him. Only 44 years old. It really, really sucks. I could probably use other words, but anyway, to watch him suffer at the end was just horrible. So many people go through this terrible disease, and unfortunately it's hit my family multiple times. But just thanks, everyone's reached out, and we did start a GoFundMe, which is over $40,000, which is amazing. Because if you are in the retail world and you shut your shop down all of December and half of November, how does that treat you? You make all your money. I'm sorry, you break even for 11 months. That's when you make your money. So there's a lot of bills, a lot of problems. But I've shared that, and you can find that on my X or LinkedIn. And so many kind people have given a donation, which is amazing, because trust me, there are a lot of bills, and my sister-in-law's got some decisions to make, what she's going to do with the shop and all types of things. But so many people were very, very kind to our family, and it means a lot. I haven't thanked everybody. I will. It's just like, it's overwhelming, everything I've been doing the last couple of weeks dealing with all this stuff. But anyway, it's just fun to get back to doing these podcasts with you, Sonu, and get back to a little more normal.
Yeah,
but again, if you're dealing with cancer, F cancer. Am I allowed to say that? I hope I'm allowed to say that on this on this podcast. You know where I'm going with that. But anyway, but thanks to everyone who's reached out for my brother Aaron. I love you, Aaron. I miss you, obviously. All right, I'm going to stop before I start crying. Don't want to start crying on my podcast. Anyway, all right, Sonu. So go ahead.
The only thing I'll say is no. Obviously, that's just I won't say the word, but that's horrible. And but I did read the obituary you wrote. On a positive note there. Yes. I mean, hopefully it's in a good place. But that obituary was really awesome to read. And I read it a couple of times, and I showed my wife as well, and felt like I knew him.
I think it went viral. Yeah, you can find it. I've shared it on my LinkedIn and on X. But cool. Yeah, it was a fun. I made it fun. I said, if anybody knows Aaron, he wouldn't want some boring standard obituary. And if you've read it, you know exactly what we're talking about. It was not a boring obituary. All right, so Sonu, yeah, well, thank you for that. But you've got about 11 minutes, maybe 12 minutes, I think, if my math is right.
About 15 minutes.
Okay, well, hey, you got to do this kid stuff, so you tell me when you want to stop. But let's go inflation, and maybe kind of weave it in with President Trump policies and things like that. But we had PPI, CPI last week. We had a big rally on the CPI print, I believe, on Wednesday. I don't know if you want to smush those two together or keep them separate. But talk to me about inflation, because obviously the market liked whatever the market saw.
No, let's talk about the market reaction first, right? The market's CPI came out, boom, everything jumped. And the good news is it didn't reverse, right? It just continued to move up later in the day. You're the technical guy, I hope, but I think that's a good thing. That, usually a big jump, people say, oh, that gap has to close, things like that. But we continue to move higher, right? The S&P 500 is up 1.8% on the day. Small caps are up 2% on the day, right? This is after the CPI report came out.
There you go.
The 10-year yield. Right, we've been talking about yields having a tough time. That's been pushed. That's been, I think, a headwind for especially, that rotation. Right, not for maybe the Mag 7, but for everyone else. Higher yields, elevated rates has been a problem. The 10-year yield fell 14 basis points, 0.14%.
It's a lot.
From close to 4.8 to about almost 4.65. Right, so it was a big move across the board. And the details are, look, CPI was soft. I mean, it was, did it need that big a reaction? If you ask me, if the numbers came where they are, how would the market react? Like, I don't know. I mean, I never know how the market is going to react, but
true.
But still, like, I wouldn't have predicted that big a reaction, but I think it was a relief. After you got the jobs report, it was good news, it was bad news. The Fed's not going to cut. We may have to wait till June or maybe even September for a cut, right? But this was like, inflation's, benign, right? The inflation picture looks good. We can breathe easy. I think that's why the market just let out a massive sigh of relief, right?
No.
And then you look at inflation, and we'll put this chart up, like I titled it, nothing sticky about it, right? I mean, it's all lag, shelter, and motor vehicle insurance. So for December itself, headline CPI came out at, I think it was 0.4%, and which was, partly due to energy prices, things like that. And core CPI, core Consumer Price Index, excluding food and energy, was up 0.2%. I think expectation is 0.3, maybe somewhere for 0.4%. So that was huge. But let's look at the year-over-year picture, right? CPI is up in 2024. CPI is up 2.3%. Core CPI is up 2.3% as well. Oh, sorry. That was December 2019. I'm looking at the name. 2.3% in December 2019. But that's a good.
Yeah, I thought it was a little higher than that.
That's a good comparison, right? So December 2024, headlines up 2.9%. So
Right.
CPI is running 60 basis points, 0.6 percentage points higher than it did in 2019. And core is up 3.2%. It's running whole 1 percentage point, 100 basis points above where it was in 2019. All of that, Ryan, is coming from two places. Owner's equivalent rent, which is basically what the BLS, estimates you and I as homeowners pay to ourselves, as rent for living in our homes. It's coming from that and motor vehicle insurance. Both of these are lagged, right? It's not real-time data. It is not a real-time picture. If you just take that core CPI picture, like I said, 3.2% versus 2.3% before the pandemic, 0.62% is that excess inflation is coming from owner's equivalent rent. 0.4 percentage points is coming from motor vehicle insurance. Everything else is net negative.
Wow.
Right. Yeah. So, and if there was something to worry about with owner's equivalent rent and motor vehicle insurance, but we know, you and I have talked about it, how this is all lagged data. Even motor vehicle insurance is because car prices went up a lot in 2021, 2022. All of us know that. And there were more crashes after the pandemic. So insurance went up a lot, insurance prices. It may be still going up. This is not to say inflation doesn't mean prices, when you say inflation is benign, doesn't mean prices are not going up, right? It's just not going up like it was 2 years ago, even, a year and a half ago. So motor vehicle insurance is on its way down. A year ago, I'm just looking at my numbers here. Let me see. Motor vehicle insurance is up 11% year over year.
Yep. Right.
Back in April of last year, April 24, it was up 23%. Right. So that's a big slowdown. And I think that slowdown is continuing. So all this to say, there's nothing sticky about inflation. I think inflation's running closer to 2% than it is 3%. But we have lag data. We've got to live with it. But I think the Fed is hopefully going to look past it as well.
Well, our good friend Jeremy Schwartz over at Wisdom Tree, they share this every time the jobs number comes out. But you look at CPI X shelter, you're talking like 1.9% year over year. Now, again, it's the Michael Jordan effect. You take Jordan off, they don't win 7 championships. So you need to count it. You need to pay attention to it. But we've been on this train for a while saying so much of why inflation's been sticky is because of shelter. And you mentioned auto insurance. And then you look at PPI. You've got, I forget the exact phrase, but the fees you pay your advisor. What's that called exactly? That's like
portfolio management fees.
Portfolio management fees. And that's because, the stock market's up a whole bunch. I mean, that's kind of like, well, I guess I'd rather pay a little more because it probably means you made more money. And that's part of that stickiness. And maybe stocks don't gain 20% a third year in a row. We don't think they will. Listening to last week, we think it's going to be a good year, but not quite that good. One thing that caught my attention just because I thought it was kind of funny, alcohol beverages down 3.2% last month for the largest 1 month drop since December of 14. Is that everybody getting ready for dry January? I mean, who knows? I don't know. But apparently alcohol cost less last month. So I don't know if that's good or bad. I don't know. What do you think of that one, Sonu?
Maybe it's good. It's not bad for anyone celebrating a win last night. So
that's true. That is true. I had absolutely not a single drop of alcohol in me yesterday to celebrate that win. But I will say on Sunday, celebrating my brother, I had more than enough. So I needed to take a day off. But it was how it goes. All right. So did you want to talk anything about PPI? We dug into CPI. I know we've only got so much time. I mean, anything stand out to PPI before we finish up with talking Trump?
This gets to one not a black swan because we know it is. One thing I keep an eye on is energy prices, right? When energy prices start to go up, I worry because, we know what happens to inflation when energy prices go up. And it's not just headline inflation. It goes into core inflation too. Last month, from the PPI data, we know that airfares, which feed into the Fed's preferred inflation metric, the Personal Consumption Expenditure Index, the PCE inflation index, airfares actually come from PPI as opposed to CPI. Airfares are up, I think, 7% or something. So, but that happens. That's happened even when inflation is running close to 2%. Like we saw that even in 2017, 2018, 2019. You sometimes get months where there's a big spike in some category, let alone airfares, right? But again, that was a little concerning. I think it reverses. I'm not too worried about that. If oil starts to hit 80, 85, 90, $95 a barrel, that's when I'll start getting butterflies in my stomach, right? I don't think that's the case. We could talk about President Trump. I mean, he's saying, we want more drilling. We want more oil. What does that do to prices? I think that puts a lid on prices.
Yeah, I'll just finish up with this. Our good friend Neil Dutta over at RINMAC, he said, like you said, airline passenger services up 7.2%. He says that could add as much as 0.1% to core PCE. So like I said, that's one we're watching. I will just quickly point out retail sales came in a tad less on the headline, up 0.4 versus expected 0.5. But again, the control group, which is a little less volatile, was 0.7 versus 0.4. Overall, I guess the consumer still looks strong at retail sales, right? Just want to wrap that up quickly, Sonu.
No, exactly. Like we talk, aggregate income growth is running at 5%, and we see that in retail sales. I think retail sales core retail sales over the last 3 months is running about 4.5%. That's if you take all the volatile stuff out, like gas station sales, auto sales, things like that. But the other thing coming back, by the way, auto sales. Auto sales are coming back. They're the highest since we've seen before the pandemic. Right, over the last 2 months. So that's a positive sign. Hopefully production comes back too. But I think that's a potential tailwind, I think, for the first part of this year.
Okay, no, interesting. I do see scribbled on my notes next to that, the Atlanta Fed wage tracker, a monthly wage tracker, dropped to 4.2 from 4.3. So wages, again, are strong, but they are coming back a little bit. Again, positives overall on that inflation backdrop. All right, so as of yesterday at noon, again on Monday at noon, on Martin Luther King Day, hopefully everyone enjoyed Martin Luther King Day. We have a new president, or maybe not. We have the same president from before, however you want to call this.
Was it 45 and 47?
They're calling it 47, yeah. So I guess it's 45 and 47. I guess, it was funny because he was doing some interviews at the desk in the Oval Office, and somebody said, "Do you have a letter in there?" And he looked, and the letter was there. I guess it was addressed 47 on the front of that letter. So I guess that's what we're going with. But listen, we talked a lot about policy last week, but what are some of the big things? I guess I'll start. All the talk about tariffs, all the talk about a strong dollar, higher yields. I just think there's such an opportunity when everyone thinks like somebody's in thinking journal patent for potentially a major peak in the dollar, major peak in yields to go lower trending dollar can really help at risk assets in general. Of course, lower trending yields can help that dispersion with some other groups leading. But again, it does come down to policy. If I think Trump said February 1st, is that Groundhog Day or February? So today's Groundhog Day, February 2nd, right?
I thought February 2nd, maybe 2nd.
Yeah. Anyway, so it might be he's looking at 25% tariffs, Mexico and Canada went up. Thinking that's what he's going to do. I think he's just talking tough, but hey, you never know. What's your take? It looked like the dollar initially sold off and small caps are popping. This is really short-term stuff, but what's your take here?
Yeah, I think, again, like last week, we saw the push and pull with inflation and labor market data, which goes to, what will the Fed do? There's also, what will the Trump administration do? Or what will the administration and the advisors say? What will Trump say, right? Two very different things. And, microcosm of that was, we saw that literally over the last 24 hours, right? Yesterday morning, this is, inauguration day in the morning. So there were some reports. Advisors say, you know what? I think there's some document which said, we are going to study the impact of tariffs, right? Study how unfair trade practices have hurt. And, when the government studies something, that's awesome because, nothing will ever get done. If you're in the camp that, if the government doesn't do much, that's not a bad thing. Let sleeping dogs lie, right? So as soon as I saw that, I just I burst out laughing. I was like, okay, we're not getting tariffs then. If a government has to study the impact of tariffs, I'll take that, right?
And maybe they should have already done it. I don't know. We've been talking tariffs since February 2018. Maybe we should have already looked into this whole thing. But anyway.
So anyway, small cap futures, because the market is closed yesterday, is Martin Luther King Day. Small cap futures run up 2% on that news. 2%. And then that Oval Office interview comes about, right? And somebody asks about tariffs and will this start, and here I am thinking, please don't ask him that. Please don't ask him that, right? Because you know what the response will be. And he said what he said. He's like, no, February 1st, we're going to put 25% tariffs on Canada and Mexico. And oh God. So his futures completely reverse. This morning, as we're talking, I don't know where the market's open now. It's up about 1% or something like that, Russell 2000 futures. So it took a full round trip, but that also gets to that policy impact, right? Policy expectations, it's a positive thing, markets run up. Suddenly it reverses, everything goes down. And you saw that with the dollar as well. The good news is, and we saw this in December, right? December when everyone was worried about tariffs, the dollar ran up 4%, right? 4%.
Yeah. Oh, yeah.
That's a big move for the world's reserve currency. Since the end of September through the peak of, the dollar hit recently, about 10 days ago. The dollar is up close to 10%. 10% in about 3 months, right? Now, over the last week, it's reversed 1.5%. I think that's been a tailwind for risk assets, and hopefully it'll continue being a tailwind. I think one thing I find weird, the Trump advisors have said they like, because you and I have talked about this, we wrote this in the Outlook as well, that we could get tariffs, but the inflationary impact of tariffs could be muted because the dollar goes up.
Yeah.
Right. And they've been talking about that as well. Several advisors have, the head of the Council of Economic Advisors, the incoming head, I should say, Steve Moran, he's talked about the dollar will go up and that will mute the inflationary impact. But here I'm thinking the dollar going up is not a good thing, right?
Right.
We don't want the dollar to go up, right? If the dollar is going up, that means, so yes, I do buy the thing that, okay, it will mute that inflationary impact of tariffs. But yeah, I don't want the dollar to go up that much. I mean, yes, strong dollar, king dollar, and all of that. But the dollar going up, you and I wrote about this in the Outlook along with Barry and Grant, that hits S&P 500 earnings, right? That hits U.S. manufacturers. So when you say, we want trade policies that help U.S. manufacturers, a strong dollar doesn't help them. It helps mute the inflationary impact of tariffs, but it doesn't help U.S. manufacturers because what does it do? It makes our goods, American goods, more expensive on the global market. And trust me, this is a global market, right? So yes, global growth is weak anyway, and a strong dollar on top of that doesn't help anything. So we'll see. I think there's a push and pull here. This is just something I think, Ryan, we probably have to live with, right?
Yeah, and if you would have told me that the dollar would be up 10% in 3 months and the move it had in December, I mean, I honestly would have thought stocks would be down more. I think stocks have, and the gold, which historically gold and dollar have been inversely related. It's not quite going that way. Gold's really held in there really well.
Exactly.
And again, we think gold makes sense. But again, just listen to last week's Outlook where we really dove into threats and opportunities, weaknesses, and the threats. The two were tariffs and U.S. dollar. I mean, so we're watching those every single day. So with all that, everybody, I think, Sonu, you've got to drop some kids off here and look at the time. So this
I need to get out in -2, -3 degree weather.
Well, that's why you're talking longer. You don't want to go. This again is episode 119 of Carson's Facts versus Feelings. Guess who's back? President Trump is back, yes, but the bull market we think is back, and my Ohio State Buckeyes are back on top.
Well done.
There you go. So anyway, everybody have a great week. Stay warm out there. Sonu, good luck getting the kids out there. And we'll be back and just keep listening to it. And it's a new year, but things still look pretty good overall, to our opinion. See everybody soon. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.